Okay, hello Renu and hello Tianshu. Let's wait for everyone else to jump in. So go ahead and turn open to page 264 of your textbooks, yeah? Business Studies. Sorry, I just realized that I had my mic muted the whole time. Okay, let's try this again. Thank you, Clarence, for calling me. So we are looking at chapter 21, business finance needs and sources. Okay, so we are looking at short-term and long-term finance. This is on page 264. Okay, again, shout out to Clarence for calling me and notifying me that my mic was on mute. Thank you for that. Okay, so let's start this again. Okay, so we're looking at short-term and long-term finance. All right, page 264. Those of you who take accounting, this should be a breeze to you. For the rest of you, just know what these terms mean and how they can help a business get cash. Okay. All right. So everyone is here. Okay. Okay, great. Just let me know in the comments if you guys can hear me now, okay? All right, so let's start with the first one. We got overdrafts, like I was mentioning. Well, you couldn't hear me, but so an overdraft is when a bank allows the company to take out more than it has in its bank account, okay? So when I was in the States, if my memory serves me correctly, my bank allowed me to have an overdraft of $200, I think. So in the States, I was getting paid every 2 weeks. You know, not like here in Malaysia, you get paid only once a month. In Australia, you get paid every week. So anyways, so in the US, if let's say you got your paycheck here, and then before the 2 weeks is over, you're starting to kind of run low on cash, or you have an emergency come up. So while waiting for this paycheck to come in, the bank allowed me to take up to $200 in an overdraft. So in other words, taking out money that I don't have in the bank. Okay, so that amount is really contingent on you know, what your credit standing is, or you know what your ability like is, or what your ability when it comes to paying back loans or money that you owe, what kind of account you have. How many assets you have, you know, all that kind of stuff. Okay, so for example, like a business, if let's say you've got 1 million ringgit in the bank in cash, but you need that 1.2 million ringgit, so that 200,000 ringgit extra that you don't have right now. So some banks can then allow their clients, the customer, the business, to then take out an extra 200,000 ringgit, which they don't have in the bank, to pay their suppliers, pay for their employees' wages, okay? And so these are usually short term, and these normally come with an interest rate as well, okay? So yeah, it's kind of flexible. You pay the interest on the money that you use in the overdraft. Okay, so if you use 200,000 ringgit in the overdraft, you get charged interest on that as well. Okay, so the whole point is that it's very short notice. The overdraft is just to kind of tide you over until like the next money comes in. Okay, so it's quite short term. The other one is trade credit, where it's really easy. The idea is that instead of, say, when you trade, right, you provide a good or service, and then the other company gives, or your customer then gives you cash, right? You exchange the good or service for cash. In this case, you're kind of trading it for credit, where you know the payment can be delayed for the supplier. It can be 2-3 months, 6 months. It really depends on what kind of credit terms that the business has with the customers, right? Or if you're the business, then what kind of credit terms you have with your suppliers, right, who gives you the goods or services. So the idea is that you can delay that cash payment for later, depending on what your credit terms are. Okay, so that's another form of short-term finance. Okay, so you can, if let's say like now, when cash flow is really tight for many businesses around the world amid this coronavirus pandemic, you know, they might have to sit down and renegotiate their trade credit or their credit terms with suppliers, banks, etc. Okay, I know airlines are having to do that right now. Okay, so that's trade credit. Well, then you got factoring of debts. So it goes back to what we saw on page 26. Well, it says here 261, factoring of debts. but I think I see it on 262 actually, so there's a typo in your textbook. 262. All right, so the idea is that, I mean, this gets a bit complicated. It's whereby, and I've had this happen to me before, although it wasn't really my debt. But the idea is that if, let's say, I owe the bank, say, ₦1,000,000, okay? So if, let's say, it doesn't work out and I'm tight on my cash flow, the debts might then be passed on to another party, like a third party, and then I can renegotiate with them. Okay, so it's like this third party then buys my debt from the bank. Why? Because if, let's say, that's their business model, they've got a higher risk tolerance, they're willing to work with me to try and get whatever money that I can pay. So right, as opposed to the bank, where the bank, no risk, we don't deal with this. Okay, so the bank sells off the debt to another company or another entity, another agent, and then I deal with them. So that can maybe help me alleviate my short-term financing. Right? What happened with me was, so somebody actually stole my identity, and opened up this internet account. This was back in the day when there was like broadband. It's like Wi-Fi, but you got a physical device, and it's like a SIM card. So it connects to the data signal that way and then boosts Wi-Fi into your house. Anyways, can't remember what it's called. I'm not going to mention the company name. So somebody had forged my identity, opened up an account, and ran up a bill of about 2,000 ringgit. I mean, not much in the bigger scheme of things, but it was a hassle. So what happened was then the company, when they closed down, they were bought by another company, and then the new owner was like, we don't want to deal with this. So sold off, factored my debt to another company, and so then they had to deal with me. I was like, this is not my fault, I'm not paying. Anyways, had to go through police and courts and all that. It was a big hassle. Anyways, so that's an example of factoring of debt. Okay, so these are some very short-term financing options that businesses have. Okay, let me know in the comments if you guys understand this, or if you need further explanation about either overdrafts, trade credit, or factoring of debts. Again, there's a typo for factoring of debts. It says there, see page 261, when really it's on page 262. Okay. Okay. Let me know in the comments before we go to long-term finance. We should be able to finish chapter 21 today, I think. I think so. That's the goal, at least. Okay, let me know in the comments if you guys understand. Okay, Sinru understands. Okay, very good. Okay, so let's move on to now long-term finance. Okay. Oh, hold on, let me remove this. Okay, so long-term finance. Okay, so actually 4 there. Okay, so first one, bank loans. Look, that's pretty straightforward, right? So long-term finance, you go to the bank, you say, hey, I need ₦1,000,000, I want to start up a business, or I need ₦1,000,000 to expand my business, whatever. You go to the bank, you work out the deals, they set you an interest rate, and it's, you set an interest rate. It can be fixed, can be flexible, and then for a set period of time as well. So 5 years, 10 years, 20 years, whatever, right? And then you pay back the bank based on the interest rate. Then you work out how much you pay back, like every month or every year, depending on the terms, or every 6 months. It just depends. And and then you pay it off slowly until the full loan plus the interest is all paid off. Okay. So that's pretty straightforward. That's long term. Hire purchase is similar, but it deals with a specific asset. Okay, so the term hire purchase is used differently in different economies. Generally, hire purchase is like for a particular asset. Okay, as opposed to say like a loan, you can take a loan to do whatever. You can buy assets, or you can just use it to pay your salaries, expand, whatever. Okay, whereas hire purchase is usually tied to an asset. Here in Malaysia and in some countries that I've been in, when you talk about hire purchase, you tend to talk about loans for cars. Okay, so hire purchase loan is for cars, mortgage is for houses. But yeah, so the idea is that hire purchase is tied to a particular asset. Okay, same thing as well. Use the interest. You sort out the interest payments, how much, how often with the bank, and then you just pay back. Okay. Now leasing is an interesting one. So leasing is kind of like a loan, but you don't actually buy the asset. Okay, so example, like if let's say you to lease a car. Okay, here's what it means. So like with a loan, right, if you take out a loan to buy a car, after you pay back the loan, you own the car. Whereas leasing is not so much. Okay, leasing is more like you take out a loan, right, to be able to use the car. Okay, and then after a period of time, you can then decide whether or not you actually want to buy the car. So you have that option. As opposed to a loan, usually you just get the money, buy the car, then you just pay back the loan. When the loan is fully paid off, then you fully own the car. Okay. Whereas leasing, the ownership is a bit muddier. So this is helpful for, like, say airlines. They have started doing this. So airlines, they're saying, look, we don't want to buy the whole planes, because all these planes are all like $1 billion, $1 billion, or hundreds of millions of dollars, right? It's so expensive, right? So instead of buying all these planes, which means you got to put out a lot more money, right? They instead lease it because they don't want to own the plane in and of itself. The reason being because with planes, they fly, from KL to Sydney, KL to London, right? Fly. There's a lot of maintenance involved. So the airline companies might say, you know what, we don't want to deal with all that. Okay, someone else can own it. You deal with all the maintenance. What we'll do is we'll pay you, we'll lease the plane from you. So it's kind of like a loan. So like every month or every year, like they pay a few $million. Okay, but at the end of that lease term, they don't own the plane. Why? Because after 5 or 10 years, maybe new models will come out, and if the airline owns those old planes, those 5-10-year-old planes, it'd be worth a lot less, right? So they say they don't want to deal with that kind of risk, right? So they might say they are willing to pay more on leasing terms, and leasing usually is higher interest. I think it's stated there in your book, right? Maybe not. So it says that the total cost of the leasing charges will be higher than purchasing the asset, right? Or even taking out a loan, right? So those 2 bullet points there, right? The firm doesn't need to pay out so much money just to buy the whole asset, like a plane or car or machine, whatever, okay? And then also the maintenance or taking care of that machine, vehicle, airplane, whatever, is taken care of by the actual owner, okay? So the airline company pays more so that the company doesn't have to deal with all the headache of maintaining it, and all that stuff. They just pay for the use of that asset, and then when it's done, it's done, right? Now they can buy it if they want to, the asset eventually, but that's usually not part of the original leasing agreement, okay? So those are the differences between leasing, hire purchase, and bank loans. So again, bank loans, very straightforward. Go to the bank, get the money, pay the interest on a set schedule every year, every 6 months, whatever, and then you can use the money for pretty much what you deem fit. Okay, hire purchase, similar, right? It's a kind of loan, but it's tied to a particular asset. Leasing, you don't even have ownership of the asset. Okay, at least not initially. You can choose to own it later, but you pay more. Okay, so leasing, think about airlines. Last but not least, and this is the big one, so this is the issuing of shares. Okay, now all the way at the bottom. So this is where you sell a portion of your company. Okay, so let's say I own 100% of my company right now, and I need long-term finance. Okay, a great way to raise money, okay, for the long term that I can use for years, is I say, okay, my company, I own 100%, just to make the math easy, is worth 100 million ringgit. Okay, I want to sell off 40% of my company. Okay, so that will immediately, if my company is worth 100 million ringgit, 40%, 40 million ringgit. So that can immediately get me 40 million ringgit in cash. I mean, it's not immediate. You've got to go through the process, go to the stock exchange, the Securities Commission, all the regulators. They want to make sure that your business is worthy enough to be sold to the public, right? The shares, right? So it's not like some illegal, dodgy company. They want to make sure you got a track record of earning profits, So you got to meet all these criteria. Get the banks, hire them. They must go out there, go find all these clients who want to buy shares in the company. But then the idea is that once you go public, as in like your shares can be traded publicly, immediately, bam, you can raise 40 million ringgit. Or if you only need 5 million, you want to retain control of 95% of your company. You only want to let go of 5% because you're thinking, I just need 5 million, right? Then you might do that also. It just depends, okay? But it's seen as a lot faster way to get money, and you get the money immediately, and you don't have to like keep paying back shareholders, right? The idea is that you transfer some ownership of your company to those who want to buy it in the market, shareholders, right? And then they give you cash, done. Okay, and then they become owners of a portion of your company, 5%, 40%, whatever, and then you get cash immediately. Then you can immediately use the money to go and expand, or, I mean, obviously you got to tell the shareholders what you plan to do with the money, and then you go and do it. But it's seen as a lot more immediate. So there are pros and cons, right? The advantage of issuing shares over, say, taking a loan is that you get money immediately, don't really have to pay interest. Sometimes you have to pay dividends, it just depends, right? But theoretically, at least you have that option of not paying those dividends. And if shareholders who buy a share in your company are okay with not getting dividends, then okay, done deal, okay? Dividends are like a share of your profits. Okay, so if let's say I say I'm going to sell my 40% of my company that's worth 100 million ringgit and going to be sold at 1 ringgit a share, let's just say, okay, 1 ringgit a share, and when you put it out there in the markets, shareholders are like, nah, that's not good enough. Okay, we want a share of your profits as well. So then the company might say, okay, fine, I'll sell you 1 share for 1 ringgit, and at the same time, in the future, we got a policy of paying out 20% of our profits, not revenue, profits. 20% will be shared out with all the shareholders. Okay, so like for example, Unilever is the one that the company that makes Dove soap, is the largest soap maker in the world. They've got a dividend policy of a ratio of about 70%, right? So over the last, I think 9-10 years, they've constantly paid more than 50%. So the idea is that out of all their profits, half or more than half, last year was 70-75% of their profits actually went out to shareholders. So shareholders are happy, yay! Not only can their share, the price grow, but then they can also get dividends. Okay, so that's dual income. Okay, but anyways, so those are dividend paying shares, but generally speaking, shares can also not pay dividends. So then it's better for the company that issues shares, because I just get the money, I spend, done. Okay, I don't have to keep sharing my profits or whatever. Okay, so that's the issuing of shares. But the disadvantage is then you then give up control of your company, right? If let's say you now own 100%, but then you needed the money, so you sell off 51% of your company, that means you no longer have majority say. Okay, 51% is gone. That means you only own 49%, right? That means if let's say you want to change your business model or change your pivot your company, create a whole new company, or make any major decisions, you no longer have the majority say because you only own 49%. The rest of the shareholders, the public, they will have to vote and decide whether I'm allowed to make those decisions. Why? Because they own 51%. Okay, so those are some disadvantages. Okay, I hope that makes sense. Then in the textbook there are other stuff as well. So long-term loans, debt finance, debentures. So it's all the same thing. Okay, that we spoke about in our previous lesson. Debentures, so debt. So instead of taking a loan from the bank, debt is I go to the market and say, okay, hey, I need a billion ringgit to expand and do this. So then you go to investors and then you work out deals with them. So as opposed to getting money from just one bank like a loan, when you issue debt, it's whoever wants to give you money, then they can give you a portion of that 1 billion ringgit. And so as a result of that 1 billion ringgit debt, they will then become like the bank. So all these people who own that debenture, it's like that piece of paper, remember I showed you guys? So that piece of paper, the contract, it says that they will get regular payments from me, fixed income, write this down, fixed income. There's a contract there that says that, okay, once I get this 1 billion ringgit from all these investors, I will pay them back, say 2%, 3%, 4% every year for 10, 20, 30 years, whatever. Okay, so that's the difference between debt, issuing debt, so when a company issues debt, versus just taking a loan from a bank. Okay, so I hope all that makes sense. I'm trying to show you guys, I was trying to pull up the graphic on page 266, so that's a good summary of all the financing options that are available to businesses. But unfortunately my laptop is not working right now for some reason. So make sure you get a look at that. Okay, now before we go into the final part of this chapter and wrap things up, just let me know in the comments if you understand what all these terms mean, right? So now it's all about understanding these terms, all these options, and then when it comes to your IGCSEs, the questions often revolve around why should company A choose financing option 1 and not 2, all right? Or they give you option 1, 2, and 3. You discuss and tell me which is the best. What is your recommendation? Okay, based on the company's, based on some information that they give on the company. Okay, so first things first, you got to understand what all these terms are: bank loans, hire purchase, leasing, issue of shares, and then the short-term ones as well. Right? So, wait, hold on. Can never seem to what I'm doing now. Long-term finance. Yeah. So make sure you know these ones as well: overdrafts, trade credit, factoring of debts. Make sure you know all of these. Okay. Before we move on, let me know in the comments if you understand. Okay. So most of you do. Kenshu, Winning. Okay. Ray, Clarence. Okay. All right. So now let's move on to the final part of the chapter. Okay, if you got any questions, post in the comments. Okay, that's about the chapter. Okay, so things to consider when getting more financing. Okay, so this is the crux of the matter, especially for your IGCSEs. Very rarely do I see them asking for the definition of, say, leasing. Okay, it's not so much about that. It's more about knowing what all those options are, short-term, long-term, and then analyzing, right? Business studies. Which of these options would you recommend to the business? Okay. It can be internal, it can be external. We spoke about that as well. Okay. All right. So here are the things to consider. So number one, what is the purpose, right? You consider the purpose, the time, the amount. Okay. So again, if let's say, going back to the overdraft. Okay. So let's say you know that your customers are going to pay you, the money. Okay. So let's say you get monthly payments from your customers. Okay. So, but it just so happened that from the end of, what is it now? April. So from the end of March till the end of April, when your customers are supposed to pay you, all of a sudden you had that emergency where like a machine broke down and you had to go and quickly buy a new machine, right? So as a result, you're short on cash because you bought that new machine. But you know that many of your clients, they pay like clockwork, they're fine, you will get money, right? So there's no point in you getting a 20-year loan, right? When you know that you're going to get money in like say a few days, okay? So what do? Probably an overdraft is just good enough, okay? And certainly there's no point in you issuing shares, right? Selling off 5% or 40% or 51% of your company, lose all that control just to help you get money to tide you over for a few days, okay? That just doesn't make sense, Okay, so understanding the purpose of that money, okay, is a big consideration. Okay, then obviously the amount needed as well. So smaller amounts tend to be like say overdraft, right? Some of these smaller ones. Bigger amounts can be just like loans, okay, from the banks. Issuing shares can be a lot, okay. So because you're basically saying, hey, I'm giving up control or ownership of my company, and this is yours forever. Okay, if my company lasts 100 years, you will own it for the next 100 years, right? As opposed to a loan, 10-year loan is just 10 years, right? So arguably issuing shares is the biggest decision. Yeah, you can get money a lot quicker, but it means you give up, basically, theoretically, you give up ownership of your company forever. Yeah, there are ways for you to buy back the shares if you want to retain full ownership of your company, but that's a different story and it's a lot more complicated. And you need cash as well to buy back your company. There are opportunity costs. The money that you use to buy back your shares, you could have used it to grow your business, buy more machines, whatever. Okay, so know the purpose, what it's for, know the time, how long you need it for, okay, and the amount. Okay, so small amounts, overdraft. Biggest arguably is selling the shares. Then in the middle you got loans, debts, all that kind of stuff. Okay. So the control. Okay, well, we haven't done legal form and size. Yeah, so basically it means how cumbersome it is. Okay, how much paperwork and legality, how much process there is involved in getting the money. Okay, so like getting a loan is pretty straightforward. Okay, you go to the bank, you say, hey, I want to get a loan. They look at what kind of assets or collateral that they can that you have in your company, right? They kind of work out the deals, but it's usually quite fast. Okay, overdraft is faster. Okay, but then if let's say you want to issue debt, it takes longer, right? It might take a few weeks or a few months to tell the markets, hey, markets, investors, I want to issue 1 billion ringgit in debt. Who wants? And then everyone will kind of talk, deal with their bankers, their brokers, whatever. And then when you get the orders, finally then only you can issue the debt. So there's a bit more of a process to it. Like I said, issuing shares is quite cumbersome as well, right? You got to go through lawyers, you got to hire the bank, say, hey, bank, come help me. I want to sell off 40% of my company. Then they help you talk to customers, find out what's a good pricing. Is 1 ringgit too low per share? Or a better price is 5 ringgit per share, right? Because they want to help you get as much money as possible when you give up ownership of your company, because then they get fees as well. And then you got to talk to the government, the authorities, right? The stock exchange. Hey, I want to sell off a part of my company. When's a good time? I want to do it on this day, this much, all that kind of stuff. Then you got to talk to the Securities Commission. They must then go through to make sure you fit all the criteria before you can actually go out there and have people own part of your company, right? So different forms of financing can be quite cumbersome. Right, the level of complexity is different, and because it deals with the legal form and the size of it, so that will influence which choice of financing you go through. Okay, so that's very important to consider. Control, like I mentioned earlier, all right. So when you issue shares, you lose control of your business. But then, if let's say when it comes to loans or leasing, you might give up some control, but not much, right? So for example, leasing, you might give up control of that particular asset, but then you give up the control for less headache and less risk of having to maintain and deal with that asset, right? So just know that. I mean, like getting a loan, you only lose control if let's say you don't pay back the loan. Right, so if let's say you took out a loan from the bank for 1 million ringgit, and then you pledge the collateral of like, I don't know, 3 of your machines that are worth 1 million ringgit altogether. So if you don't pay back your loan, then you might lose control of those 3 machines, that collateral that you have pledged to the bank, right? So so different financing options will result in different forms of losses of control. I mean, that's only fair, right? You want to get money from people, they must get something in return. If it's not interest, then it'd be control of something, right? A power over a particular asset, okay, which has value, obviously. Yeah, let me see. Yeah, issue shares, okay, long-term debt. Yeah, so grants and subsidies are always great, okay, because it's essentially free money from the government. The government gives you that money, you take it. I mean, it's often quite competitive. You have to fight for it, and then if you get the money from the government, in general, there's no interest or no loss of control. The government just wants to help you or your industry grow, or help you keep your business alive so that you can keep people employed to help the economy, right? So those are pretty sweet, grants or subsidies, okay? Yeah, let me see. Obviously then owner saving is the best in terms of, well, you don't really lose control, and then it's also immediate, but then obviously there's an opportunity cost, right? So it's your own money, and if you give it up, right, and invest it in the business, then if let's say that investment doesn't work out, then you're the one who loses, right? You take on all the risks. So yeah, pros and cons there, okay? All right, then last but not least is the risk and gearing. So this is very important. This is on page 268, okay? So we all know what risk is, right? The potential or possibility for something to either really pay off or work or fail, okay? And you just don't know. And this applies to you guys when you guys grow up and have more money, and once you start earning your money, you save money, and then you can start investing, right? Very, very important to understand your risk appetite, okay? Risk appetite means how much you want of something, right? Appetite for food, in this case, is appetite for risk, okay? So if let's say you already have a lot of loans, right? And you are confident in your ability to pay back those loans, and then you think that you might have more risk tolerance for more loans. But if the markets look at you and say, man, you're a 100 million ringgit company, every year your revenue is only 10 million ringgit, let's just say, I don't know, right? But then you take out 50 million ringgit in loans, like the math doesn't add up. So the markets, the investor might say, we don't have the kind of risk appetite for giving you more of our money, right? So that is also a very important consideration as well. Same thing with issuing shares, okay? There are companies like Netflix that have not made profit, like Uber, no profit, right? So when they go to the market, they have to tell the markets, investors, hey, we would like to sell a share of our company, but you won't get money back lah. At least not now. At least you won't get a share of our profit. Sorry, I should say that. Why? Because we got no profits to begin with. So you can get ownership in my company, Uber, Netflix, with the promise, or with the hope, not a promise, a hope, that my company will grow big enough and the value of the shares will keep growing, that then the ownership, let's say you bought it at $10 and then eventually it's worth $100 per share. That's how you make money, okay? But it's a risk, okay? So Uber or Netflix, right, these companies that are not profitable, they take a risk when they issue shares because they lose control of the company, and then investors also take the risk, okay? So when it comes to money and financing, always understand your risk appetite. Same thing applies to businesses, same thing applies to you as an individual, as a consumer, as a saver, as an investor, okay? You must understand the risk appetite, okay? Things can go great, right, and really benefit and give you high returns, or things can really go down south and just really fail spectacularly. In January, no one was talking about the coronavirus, January 2020. And here we are almost at the end of April, and that's all we talk about. No one could have foreseen it, right? We didn't expect having to do classes online. No one expect the US stock market to fall by over 30%, although it's since climbed back a little bit. No one expected oil prices to be negative, right? Those are all risks when it comes to finance, the financial markets, okay? So when it comes to finances, there are risks as well. It's very, very important, okay, to understand that. Granted, it's a lot harder to ascertain the risk appetite of a business from just the little passage that they give you in the IGCSE exams. But this is more, just know that it's an important consideration, and it's definitely very important for you in the real world as well, okay? All right, gearing is essentially, how much loans, it's usually seen as a ratio, okay? You can Google this, gearing ratio. So gearing is how much loans you're taking versus either how much assets you have or, how much income, right? So the idea is how much you owe people versus how much money you're getting, or at least your ability to generate income, okay? So the ratio here is your gearing ratio. So it really depends on the kind of company or the kind of industry. So if let's say you're like in a restaurant or a grocery store where it's all cash, right? Every day you're just getting cash. So your gearing ratio for that kind of business should be low, okay? If anything. But then for like say businesses that always need to spend a lot on capital investments, right? CapEx. You got to buy machines that are worth billions of ringgit, right? Or if you're an oil company, you want to go and dig up new oil wells, so it's going to cost billions or a lot of money. I don't know how much, but a lot of money to go get the rig there, right? Do all the testing, then only dig the oil from the ground before you can actually sell it and get money, right? So that's very capex or capital expenditure, capex heavy industries. So those capex heavy industries, then their gearing ratio is higher, okay? So it really depends, okay? So usually when we look at businesses, you look at the gearing ratio not in a company of its own, because like say an oil company's gearing ratio is a lot higher than a grocery store, right? But it doesn't necessarily mean that the grocery store is better financially than the oil company. No, you tend to compare between the same businesses in the same industry. Okay, how does this grocery store's gearing ratio stack up against this other grocery store's gearing ratio? Okay, that's a more fairer comparison. Although it's a bad example to use, it's bad to use oil companies as an example right now, because the oil markets and the oil industry is in turmoil right now. A lot of people are getting laid off. Okay, like I mentioned last time, now we're seeing earlier this week. It's Thursday now. On Monday and Tuesday, we saw oil prices in the US fall to negative. So it's not prices at the pump. This is a financial market thing. So no, but the idea was that markets were so willing to get rid of this piece of paper, this contract called a futures contract. They just want to get rid of it. Like, hey, you take this, I will give you the paper, the contract, plus money, right? So they would just like take this paper away from me because it's worthless to me right now. And I'm so desperate to get rid of this paper, I'll even pay you to get rid of this paper for me. So that's what happened in the markets. Crazy stuff. Never ever happened in the world in history before. Ever. Even if you go back to 1870 or like before the 1900s. Never ever happened before. Then this week, first time ever. So yeah. Bad example trying to use oil companies right now. But generally speaking, you don't compare across different industries. When you're looking at the gearing ratios, you look at companies from within the same industry, okay? And then, so last but not least, you look at the bottom of page 269, okay? So will banks actually give you the money, right? Will they take on the risk? Or will shareholders actually invest and buy a share in your company? Or will investors actually give you the money when you want to issue debt, right? So those questions are, what do they look at to answer those questions? Okay, so you look at page 269. So you look at the cash flow forecast. Okay, how much cash flow does this company have? Okay, that means money coming in, money going out, right? So are they able to then pay back those debts or loans? Okay, that's what the banks and bond investors will look at. Okay, income statement, and we'll look at this later on in the chapter as well. Same thing, right? So they will kind of get an idea of how much your income is, right, versus your expenditure, and then see whether you're financially strong to meet all these new financial obligations. Okay. Yeah, other loans that you have, evidence that security is available. Yeah, so security is like, okay, the bank says, I'll give you 1 million ringgit, but if you do not pay back, I can take, these 3 machines that are worth 1 million ringgit. Because if not, if you have no collateral, if you've got nothing to offer me as a security to make me feel safe that I can lend you the 1 million ringgit, I'm not going to dare to. I'm not just going to say, oh, you're my good friend, or you got a handsome face. Yeah, here's 1 million ringgit. Nah. Okay? They want some kind of security. Secure makes me feel safe. So I know I'm safe knowing that if you don't pay back my loan, I can take these assets. Okay? Then obviously a business plan. Okay, fine. If I give you that money, right? If you're an investor, okay, fine. I buy your shares in a company. I know that you have a plan for what you're going to do with that money, right? As opposed to, let's say a business sells the shares, takes all the monies and goes and buys a private boat or yacht and goes and have parties. Then you're like, well, what's the point, right? I want you to use the money to grow the business so that make me, the shareholder, make more money for me, right? That's why I give you money, right? Don't squander it. So they want to know that the business has a plan to help the business grow. Or let's say I'm a bank, right? I want to know what is your plan for this loan. Right? I give you this 1 million ringgit loan. What you gonna do? Oh, buy another 3 machines. Okay, great. All right, good. Go buy more machines, produce more goods. Then you can pay me back the loan plus interest. Okay. Then shareholders are going to think about investing if the company share price will grow or dividends are high. That's a share of the profits. Okay, know the difference. Or if you look around, there's no one really else to invest in, so they pick you, or that the business has good plans for future growth. Okay, so again, good examples are like say Uber and Netflix. No profit, but shareholders don't care. It's like, we'll keep investing. Why? Because we believe in the future of streaming video or the future of ride sharing, okay? Or like Tesla, the future of electric cars. Okay, so that's all of chapter 21. I will leave it at that. I'll give you just slightly over a minute, 70 seconds to ask any questions. If not, I'll end this video and then we'll prepare for the next class. Okay. Next lesson, we'll pick up from chapter 22, cash flow forecasting and working capital. And I guess we'll find out soon enough whether that chapter will be done in person or virtually as well. Let me know in the comments if you have any questions. If not, just say thank you very much. Let me know if you understand today's class. So say, I understand, thank you, goodbye. If not, ask me questions, okay? Okay, thank you Sinru, thank you Otian, thank you Ray. Go take a break and then we'll come back for econs. Yeah. Thank you Winning. Thank you Sherwin, thank you Chien, thank you Naomi, thank you Cheryl, thank you I believe Shireen as well, and thank you Tian Chi. Thank you Clarence. Okay, I'll end this in 10 seconds. No questions? All right, see you.